We're going to do a quick last conversation here today on commodity prices. Nickel prices are at a 20-day high, perhaps playing catch-up with other base metals, which have gained over the last 2 weeks as well, if not the last several months. It comes on the back of a great year for almost all base metals. So a quick view coming in from David Lennox of Fat Profits. David joins us from Sydney. David, we've seen some buoyancy come back into rates today and yesterday over the last few weeks. What's looking best for you right now? And how would you compare the positive increases we've seen in nickel, in zinc, in lead, with the decline in iron ore? What would you attribute that to?
Oh, good morning. Certainly, if you have a look at the base metals, we have seen quite a positive move across the broader spectrum of commodities in the sector. And that's on the back of the fact that we are now starting to look into 2018, and we're starting to believe that a number of the commodities will move into deficit supply conditions, and that will certainly support prices. In terms of where we're standing at the moment, we do like the look of zinc. It has been in deficit supply in 2017 already and will remain that way and go even further so in 2018. And what we've seen over the course of this year is a drawdown in zinc inventories, more so than we've seen through any of the other commodity LME inventories for this year. So at this point in time, we're very comfortable to suggest that zinc will continue to rally, even though we have seen it hit record highs already. We believe that 2018 will continue that trend. Not far behind, we will see copper, we think, as that we believe that particular commodity will go into deficit supply in 2018 for sure. And that will, we believe, add significant tailwinds to the copper prices for next year.
Mm-hmm. So if you look at the returns year to date, this year it's between 15 and 30% for these key base metals. What kind of price rise do you foresee? Do you have any forecast for 2018, like you mentioned?
Look, at this stage, we're only looking at probably fairly mild increases. We are still waiting to get through to the end of 2017 before we start to set those prices. But we'd be looking to between probably about 10 to 15% movements on top of what we've seen this year already for 2018. So we're not looking for the lights to be shot out for commodity prices in 2018, but we do expect to see that trend to the upside over the course of the next year.
Don't you think the upside, in all these metals is kind of being driven by a single engine, that is China? And how do you really see the policy of Chinese government over the next few months towards the end of this year? And based on that, do you see an upside for the coming quarter?
Oh, look, there's no doubt that China's been the key driver of commodity prices now for some years, not just this year, but probably for the last 3 years. However, what we're seeing in 2018 is a slightly better US economy, as we see that economy start to recover through 2017 and going into 18. We're also seeing your own country's economy continue to remain quite robust in 2018. And what we're seeing that we haven't seen right up until now has in fact been the green shoots of economic growth coming out of the Eurozone. If we do throw all of those together, that would suggest to us that global industrial production and the global economy is looking to improve over the course of 2018. That's what we believe will be driving the prices higher for commodities, not just the China story, but now supplemented by a number of other key economies starting to show improvements in the course of next year.
David, a more medium-term look or a shorter-term look on iron ore prices?
Look, the iron ore price has been suffering because every time we see it move up towards the $70 region, there seems to be a tsunami of supply coming on, or suggested tsunami of supply that will be coming on stream, and that does drive the price back down. We do believe in 2018 that the steel sector will continue to perform quite robustly, as we've seen in 2017, even with the compacting of steel manufacturing down into the super mills in China. We believe that 2018 will be quite a good year for the steel manufacturers, and with that we believe the iron ore price will follow there soon after.
Mm-hmm. And aluminium, a quick medium-term outlook on aluminium as well?
Aluminium's really done quite well this year, primarily because we've seen a closure of let's say, polluting refineries in China, and that closures haven't been quite taken up fully by the super mills that they have been constructing. So there's been a bit of a shortfall in terms of the supply equation, and that's now very quickly started to feed through to the aluminium price. We believe in 2018 that's going to continue, and we'll see with perhaps an upkick in economic production across the globe, we'll see a much better demand coming for the aluminium sector, and that will see prices continue to firm over the course of next year.
David, do you think iron ore could fall further in winter because China will try and curb pollution, as they had done last year, and also I think the process has already started?
Look, there's no doubt that, yes, we're in the quiet season now coming into the Northern Hemisphere winter, so we would expect to see some weakness in the iron ore price, as we are perhaps seeing starting to unfold at the moment, but we're not expecting to see the prices drop significantly from these points. We do believe that we'll come to the end of December and we'll be starting to look very quickly to restocking for 2018, and once that happens, we do expect to see a very quick and very decisive recovery in the iron ore prices towards the end of 2017.
David, thank you so much for speaking with Bloomberg Quint this morning and for that quick outlook on commodity prices in the medium and longer term. With that, we're wrapping it up here on this show.